Great, thank you, Robert, and thank you for the kind words, and thank you for not making fun of Mississippi State's football, as I know it's pretty easy to do. As Robert mentioned, my name is Ryan Montalbano. I'm an associate portfolio manager for real estate at the UPS Group Trust. We serve as the corporate pension for the broader logistics company located here in Atlanta, Georgia. UPS, not to be confused with the three-letter European financial services firm that just acquired their largest competitor. But I would also like to thank the CFA Society of Atlanta for having me on this panel. I'm honored to share the stage with these four highly accomplished panelists whose expertise range across the real estate and institutional management space. So I know a bio was included in the flyer that went out on the website and on LinkedIn. But I'll ask each panelist to give a quick bio on themselves and their firm, and I think we can start down on the interview.
Thanks. So my name is Laler, DeCosta. I work for Invesco Real Estate. Invesco Real Estate is wholly owned by hometown Invesco. We're a global real estate management firm. We manage about $90 billion in assets. We manage both public and private, and we manage in strategies across the risk spectrum. And I just want to say thanks to Ryan and to the CFA Society for having me today.
Hi everyone, my name is Michael O'Connor. I'm a managing director with Clarion Partners. Clarion is part of the Franklin Templeton investment management platform. I've been with Clarion for 26 years. I work out of our New York office, and I currently serve as assistant portfolio manager for our real estate multifamily strategy, private equity, that leverages the Gables residential platform. And so some of you may know Gables. They've been long headquartered here in Atlanta.
Srini Prabhu. Hello, Srini Prabhu here. Angel Capital based in Atlanta, 18 billion of assets under management. We focus across fixed income for institutional and retail clients with primary focus on residential mortgage credit, consumer credit, and commercial credit.
Hi, my name is Don Mullen. I'm the founder and CEO of a company called Pretium. We're the largest, is that better? Thanks for the cues. We're the largest single family rental firm in the United States. We're also focused on residential credit and corporate credit. And by way of background, I used to run mortgages and corporate credit at Goldman Sachs.
Great. Thank you all for coming. Can you all hear my mic okay?
No.
Okay. Well, I'll speak really loud for the first question, and I'll try and go and turn up the volume. But the first question is pretty broad, but where is this distress that we keep hearing about? Is it already here, or is it behind the door waiting up for us to open it?
I'll take a quick shot at it, and I'll say, we're starting to see it. You're starting to read about a few office transactions where people haven't been able to refinance and people have finally decided to sell at very distressed prices. But transaction activity is still pretty slow, so we're not seeing a ton of it. We expect that we'll see some in the multifamily space, particularly with assets that were purchased late in the cycle, maybe at very, very low cap rates, maybe over-levered with floating rate debt, and that's coming to haunt folks a little bit right now. But so we think we'll see a continued repricing in the market. We're seeing a little bit more distress outside of the U.S. So in Europe, people have recognized valuation declines a little quicker, and we're actually seeing some actionable transactions there. But we think the repricing is clearly going to lead to probably some attractive vintage year opportunities over the next year or so.
I agree with Laler, particularly when it comes to the floating rate debt, right? So when you think about the space that a lot of our clients are in, the institutional investors are investing in real estate over a long-term cycle, they tend to be more core and core plus, and then occasionally we'll do some more opportunistic. But and when they're doing so, they are using more fixed rate debt. But the folks that were doing some more investments in 2021, 2022, They were trying to do more value add and opportunistic using floating rate debt. That, I completely agree that we're now getting into an environment where that's starting to squeeze balance sheets for some folks. And as the debt comes due, and maybe there are caps, some folks may have had caps on the debt, and those start to expire, we believe that there's going to start to be some capital gap funding need in the market, similar to what there was during COVID, particularly in middle 2020, where a number of owners were starting to go into the market looking for slices of capital to help infuse into their capital stack so that they could retain the asset. I do also agree that there are certain sectors that are more stressed than others. Obviously, the office sector, really creating a bifurcation for really primo assets and primo locations, still getting some decent rents in particular markets, and those assets that are more tertiary, older assets that tenants are not looking to be able to attract employees or having difficulty in attracting employees. Those are definitely going to be challenged over the near term.
Yeah, well, I agree with all those points, and if we really think about it, the most interest rate sensitive sector is housing, and housing came into this in a much better position than it was in the last financial crisis that we went through. And so what you're seeing now is, as the rates have continued to stay high for 16 plus months, now you're seeing the other sectors where refinancing of those assets or transitional, whether it's a multifamily, office, and that's where the problems are going to bleed into. So it's been a timing thing more than anything else, but we're seeing it. We also feel that there are parts of the corporate market which should have to bear the pain, and we haven't seen that yet. But commercial is the one space that everybody talks about, and there are a variety of different things in each sector of the real estate market on the commercial side.
Thank you. So I usually like to be more controversial than just agree with the three guys in front of me. So maybe I'll just be a little expansive. First, I'd characterize where we are as not the end of the beginning, like we all like to say that fancy phrase or cute phrase. It's the beginning of the beginning. This is barely started. I'm remembering having been through so many corporate credit cycles. We used to, differentiate between good companies with bad balance sheets in some cycles. It was like the early 90s. In the early 21st century, we had bad companies with bad balance sheets, and your recoveries were very little. And this time in real estate, I think we have both. Office is so highly disrupted. The dispersion is going to be incredible, and we barely begin to see the process yet because people are paying their leases. Corporate America is not defaulting yet. We don't see a lot of that going on, but office vacancy is massive. Our office is in New York City. If you go to somebody who's at One Vanderbilt, which is like considered the best office space in New York, it's packed. You go to any other building, it's like 50 to 60%. So as leases roll off, people are not going to renew them, they're going to downsize. And the obvious problem is, what everybody was talking about last week was WeWork, where it was flex office space or temporary office space, and when they go, which they will, they're going to have a huge problem with the leases they're going to end up putting back. So I would say that office space is going to have the highest dispersion that we've seen in sort of office history, where highly sought after office space will continue to have high rents, and some stuff you will not be able to give it away because people refuse to work there. Multifamily, I think, is a good example more of good businesses with bad balance sheets. So most of them are pretty reliable operators. There's always going to be stuff that's in bad locations that have been poorly managed, but generally speaking, it's over-levered relative to the amount of cash flow they can generate and the current level of interest rates. So from my opinion, the beginning of the beginning and a great time for real estate debt investing.
Great, thank you. That's much better. So you all touched on the debt. What are lenders doing right now with their problem loans? Are they taking assets back, or are they kicking the can down the road?
Hard as you can. So regulators are obviously encouraging extensions and that sort of thing. I mean, we're a lender, and we are perfectly willing to work with our borrowers to the extent we've got good sponsorship, and to the extent they're willing to continue to invest in their assets. And if they're willing to do that, then certainly, giving an extension and giving some time to for capital markets to at least stabilize, if not improve, is probably a prudent thing to do. And from the banks, I think the regulators are encouraging the same thing, so I think that's what we're seeing. But in all cases, at least for us, we want to see equity coming into the assets. And we are assuming that we've made a loan to somebody that we have faith in as an operator.
I think the last point that you made about putting equity into the assets is what the lenders are focused on. They're looking at their relationships and how have those relationships, the borrowing relationships, been over long periods of time. How have the borrowers acted during times of stress? And then they're focusing then on spending more of their lending activity with those relationships. We are certainly seeing it, where at least we are in a position where we continue to get some capital to even effectuate development in this environment. But there isn't as much capital for that type of activity as there was, say, 18 months ago. But they want to be able to see that they're putting debt with lenders, with borrowers who can actually fund their projects, meaning putting more equity in, right? A lot of developments that we're doing today, we could get 65% loan to cost 2 years ago. Now we're in an environment where it's more in the 50 to 55%. So they're looking for those who are looking to continue to invest, put more money, put more skin in the game, and show that they have the wherewithal, if things do go sideways, that they can continue to fund those assets.
Yeah, speaking of the banks, we have investments in banks to the sub-debt side, and what we can tell you talking to the bank CFOs and just looking at the balance sheets, these are very squeezed balance sheets right now, with NIM going down every day. This is something that the Fed will have to think through, is you can kick the can down the road, but these banks have no ability to take losses right now. And sometimes your first loss is your best loss. But that all accrues over time, and they're going to need private lenders to come in and support it. But that's the pain trade as the unwind happens. It's going to happen for both sides. So people looking for debt, and then people who own the existing debt, and what do they do with it?
I think this is a bit different than other cycles where everybody wanted to extend because they could see the other side of the valley. And right now, you can't see where we're going. So extend and pretend is harder to do when you don't know where you're going. And that's why I think you see many more people willing to throw the keys to the lender very rapidly, where that was considered, it had stigma attached, and now it's considered prudence. Get rid of the bad assets, call the portfolio, give the keys over as fast as you can. So I think extend and pretend is the dance that two people have to want to do. And I think the lenders want to do it more than the equity in a lot of cases right now. And the equity just wants to clean up the portfolio because they're like, apartment buildings in San Francisco, maybe not so much anymore. Offices in downtown, yeah, that was a good idea 5 years ago. And so as a result, I think I go back to my theme of dispersion, which is good assets that are in great positions, people will put more money into to see what happens, and assets that are unknown in their value will need to clear the market with someone else's equity. And so as a result, the debt is likely to become the equity. I'd also say that the comment was made both about banks and about new capital. It is a great time to be a new lender in a lot of markets because the cost of debt capital is so high because banks are so stretched. Right now, the NIM, I agree with you, is a problem, but it's also, listen, if you take deposits out of these institutions at the pace that was going on for the last 9 months, it didn't matter if the CEO was good or bad at managing risk. They're just screwed because they don't have enough deposits. So as a result, as Srini said, I think this is the era of great private debt capital markets expanding into real estate. And I think you'll see a lot more capital raised from sovereign wealth funds and pension plans around the world focusing on this category. We see in Europe a big focus, in Australia a big focus with our clients, and it's going to increasingly come here. People don't want the equity, they want the debt.
And so, Don, when we finally can see the beginning of the end of this cycle, How long do you think it will be a more prolonged recovery similar to the GFC, or will it be similar to COVID where it was kind of a snapback in values?
Definitely not COVID. And the reason why is in part it's easy to snap things back despite the horror of that when you drive interest rates to zero. We're going to have persistently high interest rates. The Fed's bias is to make sure it strangles inflation, particularly since their credibility was so put at risk for that institution. And no one wants to be the head of the Fed that everybody looks back at 30 years later and said, that guy was really stupid, right? Look at the thing that he did. And so nobody looks back at Arthur Burns, of those who are old enough to remember, and say he was a genius. They all say he was really stupid, right? And he helped create the inflation cycle of the 70s. And so no head of the Fed wants to be that person. So they're gonna start this thing probably too long, right? So I think it's a little bullish to think we're cutting rates in the second quarter of next year, right? I think that we're in a position that the data would already have to be much worse. So with that, I think the other side will be when we see more forcing function on sale of assets. We see very modest forcing function. So this will be more prolonged, look more like classic credit cycles. My prediction has been there'll be a smaller version of the period 1990 to 1994. Because the Fed will be eating up. The FDIC is already eating assets. It's going to eat more assets. It's been the contributor to the widening of ABS spreads, peaking out, lots of securitizations. They're going to have to sell lots of loans eventually when they start taking them over. And concurrent with that, people have to figure out what we're going to do with the excess office space. So I think we got a ways to go in real estate, too.
Anybody have a more optimistic case?
You could make a lot of money during a period like that. Right? You can. Barry Sternlicht was created.
The only thing I would add is, like, we are at a really interesting time because we have, the market is bifurcated. Investors, many investors, and if you look at any consensus of what folks believe interest rates are going to do, the investment market, Bloomberg consensus is that the 10-year treasury is going to go back to 3.5, which is completely counter to what the Fed is trying to accomplish. So when you have the investment market believing it's going to go there, and they're making decisions based on rates going back to something that's a bit more palatable than 4.2, and then that will conceivably start to unstick the market. But I don't think that it's all worked itself out. I mean, I kind of agree with Don, is that if we end up in an environment where 10-year treasuries are high for a long period of time, that you are over 4 or 4.5, the market hasn't adjusted to that yet. And it's only adjusted to the fact that it's not 2. And they think it's going to come back down, right? And so that's why we have values that are starting to adjust to what happened a year ago, and it's starting to get somewhere. But if the market really then believes that we're going to be over a 4% 10-year treasury market, then we have a much bigger valley to get through, as Don has pointed out.
Are you, so I take it no one on the panel is particularly excited about any sort of property type at the moment from the equity perspective?
Well, I think that the different property types are all different at this point, and everything is not office. I mean, office is, for a diversified owner, is a lot smaller part of the overall portfolio than it used to be. It's a big problem. I agree with that completely, but you know, in the other sectors, we are still at this point, and it could definitely get worse, but we're clearly still seeing demand, you know, that's reduced, but it's still positive. So I think we do like some of the other sectors a good bit better.
I think the one contrarian this time around is single-family housing, and we've seen the shortage in that space, and you know that's going to take a long time to get together, and that's one of the things about direct lending that Don mentioned. There's so many opportunities in that space on behalf of institutional investors, and for the first time, we were just chatting about it before we started the panel. This is the first time when we talk to institutional investors, they're looking at more at real estate direct lending as a basket that they've never looked at before. And so that's going to be obviously that money has to be raised, but that's where we see opportunities for the equity side.
So we kind of touched on this, but what can the Fed do in order to open the capital markets and or the securitization markets?
Well, I don't think they want to. Right? I mean, you're asking them to do something that they're trying to stop from happening. They want the force of cycle, right? They want to make capital difficult to access. They want to be in a position where they're slowing the economy down. So the unemployment rate scares the bejesus out of them, right? The growth rate in the second quarter was not what they were looking for at all. And they're basically telling you that they don't believe that you can have low inflation and this growth rate and this level of unemployment. They're not hiding it. They're saying it. They're just trying to engineer a less painful landing. And so I don't think that they're trying to improve access to capital. They're trying to reduce access to capital. And if they see a wild dysfunction, they'll try to mitigate that through a direct action on that product, right? Like by ABS if they really think it's really out of whack. But I don't think you're going to see them take action anytime soon. They're trying to reduce the growth rate of the country, period.
But stabilizing rates will be helpful. At least people will know what they're dealing with, and then we still have to adjust values. We have to make cap rates and debt rates at least bear some resemblance to each other, and that would help people feel better about transacting.
Agree, 100% agree.
And we've kind of seen that in the REIT market, right? You've seen the pullback in the REITs down, I think it was over 40% at the trough. Meanwhile, Odyssey and private core real estate, I think, is down closer to only 13% for the year. So how much further does private real estate have to go?
So there's been there's always a comparison to public and private, right? And is public a harbinger of where private values are going to go? But one thing I think that folks need to also realize is that when we're looking at private, we're typically focused on the benchmark for private real estate, which is generated by property appraisals, predominantly property appraisal, external property appraisals, whether it's a fund or a separate account that has an outside valuer that's valuing these things. And when we look at the benchmark over the last couple of years, the benchmark itself, even going back to in 2022, it never actually went to pricing where the spot market was. So I'll use the sector that I play in most of the time, which is multifamily. You know, cap rates pre-pandemic for Class A product was generally in a 4 to 4.5 cap range, depending on the market, depending on the location. And we got into an environment where, coming out of COVID, when the market got really hot in 21 and early 22, cap rates, spot market cap rates for Class A product was in the low 3s, high 2s. Actually, we sold a property here in Atlanta for 2.9% cap rate, which was quite unbelievable, frankly. But the benchmark, the lowest for multifamily in the benchmark, was a cap rate of 3.6, and in a market when things were trading at 3. So you have a very slow movement of private market values just because of the structural nature of how the valuations are calculated. In the same token, we're now in an environment where, as Laler pointed out, we don't have a lot of transactions. We're starting to see more multifamily transactions happening actually this quarter than we had last quarter. But without transactions, the appraisers don't have a ton to go on, so they're moving in a direction, they're moving higher. You know, we're up to, the benchmark today is at about a 4.3, and we are seeing spot transactions anywhere from 4.5 to 5.25, right? So do we think we're going to get to that place? I can't tell you that, but that's where, again, the appraisers are starting to move in a direction in the same way. They never moved to the low pricing area, and the question is, will they now get to what's going on in the market? I think it's going to be somewhere in between.
Yeah, I can speak from the REIT side. We also have a mortgage REIT that we manage, and this is on the residential side. But I think what we have to see is there will be operators that are good at it, that will manage themselves out of it. But there's always people that will do scope creep in an environment of zero interest rates. And so you have a couple of REITs that announced that they took impairments on their multifamily. And so the question is, as we go to this environment where all those small bodies worry, where they don't have the expertise to underwrite those assets, and that's where valuation will change.
Yeah, and we're seeing more valuation change when cap rates are really low, like in multifamily, but even in like industrial, in the coastal markets, where cap rates were also 3 plus or minus, you're seeing bigger adjustments than in markets where cap rates were 5.5.
Yeah, obviously, I'm most familiar with single-family REITs versus the private markets, and I would say that having, in that specific segment, the repricing that takes place often is more reflective of the macro perception at the moment than the long-term opportunity in the sector. And so you see a lot of volatility that's not necessarily correlated with the fundamentals of the investment strategy at that time. And so, most of our clients would rather own the real assets than get anywhere near the REITs. So it's just a different investment strategy.
And then, so we kind of touched on appraisals, but what are some of the major differences at the moment between the appraisals from being conducted on the equity side versus the debt side?
I can really speak to the equity side.
Yeah.
Is anyone dealing with debt appraisals?
No, you're talking about commercial side.
Yeah.
I mean, on the commercial side, what you're seeing is, and I can speak from it from the CMBS markets and the public markets. Everybody's already trading to a point where you basically don't even want to do the debt. And so I think from a valuation perspective, you're pretty much trading to this wide levels. And that's just because, till a couple of months ago, we had no idea where the Fed was going to finish. We still probably don't, but there's a little bit more stability on the rate side that we can manage on the spread side. Same thing happened on the residential side all of last year, right? They already did that on the resi side. Another thing that we don't talk about in the pricing of debt is the buyers of this debt, whether it's on the CPR side, which is the securitization, are a lot of money managers, and they have mutual funds, and we can tell you that a lot of the mutual funds have gotten redeemed. Clients are sitting on money market funds. So where does that cash come in to reprice it? So people just widen it out. So if you think rates are going to go up 200 basis points, you just widen out the spreads on the 200 basis points. So it could be irrational for a period of time, and depending on the sectors, obviously, but that's what we see on that side.
So we have 2 businesses that use appraisals, mostly single-family rentals. Again, not exclusively, mostly. And so we're a lender to home builders. We're a lender to fix and flip guys. We're a lender to homeowners. And obviously, we own 100,000 houses. So we kind of look at the same ecosystem always. Debt appraisals are definitely, on single-family homes, very backward-looking. So we've gotten very comfortable leaning in because we have a strong view about the demographic imbalance that's taking place in the country. Not just where people are moving, but the fact that we just have more folks than we have houses. And the folks who live in houses don't want to move out of houses. And they don't want to move out of houses not just because they're mortgages, because old people stay longer. It used to be at 60 years old, people moved out of a single family home and moved into something else. Now they don't move till they're 75. So it's a huge amount of inventory sucked out of the marketplace, while you still have household formations taking place where people want to buy them. So you're just going to continue to see upward pressure on home prices. And so as a result, we lean in more than the debt appraisal would imply we should, because we like to operate more on a fundamental and a trended data view, rather than try to drive as fast as we can looking through the rearview mirror. That's kind of hard. And so we have a different outlook for that. But otherwise, I think that we'll continue to see home prices continue to creep up, not the pace they've been. And I go back to emphasize again that there's going to be a great debt lending opportunity go forward because of what's happened to the banking system.
And so with that great debt opportunity, I'm assuming it's because you're getting a higher cost of debt. What does that mean for equity returns? As an LP, should I expect a higher return on my equity just given the higher cost of debt, or should we expect that our equity return should be moderated just given that cost?
I have it, so I'll finish and hand it off. At first, I think part of the space that you're going to get is not necessarily in the markets where you stabilized an asset. So let's cut that off. The first place that we're seeing a huge spike in the cost of debt is in the development component, which, again, I don't know how much, again, I know single family homes the best, and in the development component for land and home building, if your name is in Lennar or D.R. Horton, your cost of debt capital went up a ton. And so as a result, what we see is that the ability to lend in that space is mid-teens, unlevered, very attractive stuff. And so, yes, if you're putting, I guess, equity into land development, your returns are going down. There is just no doubt about it because the debt's taking more of the return. I think that we see much more reasonable cost of debt capital in less riskier segments where there's stabilized assets, like single-family home securitizations. The debt cost is up, but it's not as extreme as the change in development lending. And I think you'll see, as Srini implied, you're going to see increasing amounts of institutions. We, as an example, put a lot of this new debt on the balance sheet of insurance companies because they actually have a worse cap charge for securitization than they have for whole loans. And that's a big change that we're going to see in the market.
Yeah, I agree with Don. Where we are seeing more is from insurance companies. And not just that, we tend to forget that they also have access to the home loan bank financing.
Yes.
Which is not just for the banks, but insurance companies. Where we are seeing is a capital formation coming from sovereigns, pensions, and a lot of them have an opportunity to move into the private debt side on an unlevered basis. So there's a difference between, to give you a perspective, we're in the securitization market almost monthly along with Pretium, and to 2021 we were making mortgage loans at 4.5%, funded at 1%. Just to give you guys a perspective. And today, funding cost is about 6.5%, mortgage rates are 8.5%. So there will be financing available for better properties, better assets, and that stability is coming in. But there's a new wave of investors that are coming in because the pensions and insurance companies didn't want to own these assets unlevered at 3.5%, 4.5%. You're seeing residential, especially in the residential space, these yields approaching where unlevered money is coming in, and that's going to be, and again, it gets back to the shadow banking where assets are transitioning outside the banking system.
Maybe answer your, the gimpy mic. Well, I'll come at it a little bit of a different way to answer your question, Ryan, right? So to me, it's a matter of what is the market requiring for returns for a particular type. And I come back to core investing, right? Core investing, which typically would have moderate leverage. So let's say it's not more than 40 to 50%, right? So pre-pandemic core investing was requiring a 7 to 8% levered return, right? And again, there's a lot of buyers that don't use leverage, but unfortunately, the market pricing is determined by the folks that use leverage, okay? So you have to actually back into it, and kind of back into it this way, right? So then the question is, in today's environment, with where debt rates are, is a 7 to 8% number a good number? It probably has a premium to it because we're in an unsettled environment. So again, I don't know what that is. It's all dependent on the investor, but let's just say that number is 7.5 to 9, right? If someone's trying to get a 7.5 to 9 on a core product today, from there you can then back into what should the unlevered return be, okay, based on where debt rates are and where we think debt rates will be, right? And again, it seems to us as we are monitoring the transactions that are happening in the market that that's kind of where the market is, at least for core product. But then there's also a segment of the market that is just throwing pricing in. They're throwing in because they want, maybe I can bottom feed. Maybe I can throw in a price and someone will bite because they may have some distress, or they may have a deadline or a maturity or something to actually transact. But for most folks that don't need to transact, they're not, right? So I think one of the questions, right, Ryan, that you have asked, are we in a recession? We're certainly not in an economic recession, but it seems we're almost a little bit in a financial recession, because the market is just, when you're in an environment, as Laler said, where you don't know where pricing is or where it should be, you just stop. If you can, if you have the ability to stop, you just stop until you wait till things settle down and you know where pricing should be for where the rates are. But we're not in that environment right now.
I mean, simply put, I mean, equity rates are going up. Cap rates are up. They're not up enough yet, but they're up. Discount rates and appraisals are up. So equity is not backing away and saying, I want less and let debt have it. But they may not be up proportionately as much as debt returns are, but I think still the requirement for the equity is going up.
So my GP hurdle should be higher for the prep, right?
I'm not taking it
Opportunistic
away.
funds, and it was 8 before rates went down, it was 8 when rates were down, you didn't cut it down, and it's 8 now again.
Unfortunately, and so when you all speak to your LPs, you guys represent a wide range of clients and LP bases. What are some of the concerns that you all are hearing from them? And if you could relate them back to past cycles, that would be interesting as well.
Well, number one concern is we're diversified managers, so the number one concern that we hear is office. And you have to, if you have a diversified portfolio, you've got to explain how much office you have. You've got to walk through the assets and explain how you're positioned and what's going on. Kind of the number two thing that we're hearing about right now is valuations. We have open-end funds that are valued quarterly, so everybody's concerned about valuations and have you moved them down fast enough, and there's some frustration with the appraisal community for not getting them down quicker. And then kind of the third most important thing is office valuations. That's the big issue that we talk about. But having said that, and I think we'll talk about it later, but we are starting to have more LP conversations about new investment as we've gotten a little farther along with this, and people are interested in the opportunities that are out there.
And the only thing I would add differently, I agree with all of those items in terms of being on our limited partners radar. One of the things that is interesting when you compare where we are now with COVID, one of the experiences with COVID is that when COVID unwound essentially at the end of 2020 and we moved into 21, there was a tremendous amount of capital that came off the sidelines and went into real estate funds and went into real estate investments on the institutional side. And some investors were left kind of outside the door. They actually were entry queues rather than exit queues, right? And so as a result of that experience, there are a number of investors that we have that are actually trying to do due diligence now, thinking that when the market unsticks, that they can move quickly. Because to come into a number of institutional funds, it takes time. It takes time to due diligence. It takes time to go through the manager, go through all your compliance, go through everything. So a number of folks now are trying to get it all done in advance so that they can pull the trigger when the market unwinds. They don't want to be left looking in when hopefully the market does readjust, say at the end of the year or in the early part of 24. They want to be able to move quickly.
Yeah, I'll give you the negatives and the positives of what we hear from institutional investors, the pension sovereigns, etc. Is a lot of them have a denominator effect because their private equity investments are not delivering them the cash flows that they need and getting extended. And so they're sitting in an environment, A, when they know, they feel there's distress happening, they don't know how to value it, and they have less cash on hand to put to work. So that's been a tough challenge for them last year. The positive of that, and we've seen this across the community, investing community institutionally, is the amount of emphasis that their boards are putting on direct lending and private credit. And so private credit is a buzzword that was used for a long time, but it was really focused on corporate credit. That was the biggest. And I mean, Don can expand on it more too, but we're seeing a lot of guys saying, hey, this is my opportunity to get into direct lending on not just on the residential side, but more on the real estate side across the board. And you will see a lot of that money come in. It will first come into sectors which are more stable. And as opportunities come in, you're right, that money will start flowing in. And that really, again, creates the basis of what we call assets leaving the banking system.
I guess the one thing I would add to what's been said already is that one of our key conversations with LPs and prospective LPs is relative value. Not an uncommon phenomenon when you start draining the liquidity out of the system. People start comparing relative yields and returns more than they did when everyone was flush with liquidity. And so I've learned more about debt financing in Australia than I really cared to know about, or office financing in Dusseldorf than I cared to know about. But I do have those conversations whether in Singapore, Abu Dhabi, Australia. There's a big relative value conversation as people are deciding where to allocate. So relative value, fundamentals is obviously a big topic, whether it's single family homes or office space, and then as we talked about earlier, how do I think about that relative to the forward?
And so, other than debt, are there any specific strategies that you're seeing your LPs invest into? This is your chance to give yourself a pat on the back for fundraising over the last couple of years, because I know it's been difficult, right?
So the debt space is very interesting. We definitely think it's the best idea. We're getting traction, and given the yields that we can get on property sectors that we like, not property sectors that we would rather not be in, at today's valuations, feels pretty good. Outside of that, I think we've seen more interest in the higher returning spaces, because LPs, if they have capital to invest and they see distress, they want a part of it. So the focus has been on the higher returning strategies, and that's around the world. So, we've been fortunate in the US. We're seeing a lot of interest in Asia and Europe right now in high return strategies. So all very, very positive. And then I agree with the other comments that even on the core plus space, people are starting to think, if 2024 is going to be interesting, I have to go to work now. I have to pick a manager. I have to do documents. I have to get in somebody's queue and wait till they see opportunity. So it all takes time. So the good news is LPs are talking about investing again, and that's a good thing.
The one thing that we're noticing is that folks are being much more selective about where they're investing in terms of actually being more silver bullety about sector, rather than just doing a diversified strategy, which would typically be an easy trigger. In today's environment, given that there is some flux between the different property types, we're finding much more interest in specialty sectors, going into a logistics fund, whether it's in Europe or the US. Even in this environment where values are adjusting, when you look at relatively, as Don pointed out, industrial still is a healthy sector. Multifamily still a healthy sector, relatively healthy sector, and it should continue to be given the issues in the single family housing market. It is, when I look at, one of the questions you asked earlier is what makes you feel good about particular sectors. It's interesting, the single family housing market should continue to be inventory constrained, if you will, because there's still a supply gap with the amount of single family that's being brought to the U.S. market, into the U.S. market. And we also have come through something that's really interesting that I've read a number of government articles about this, is that when you think about homeowners, I'm a homeowner, I'm sure many of you in the room here are a homeowner, my interest rate on my mortgage is 3%. And about more than 80% of single-family homeowners today have an average interest rate of around 4%, right, or less. And when the market is 6.5 to 7, why would you move unless you have to, right? You're not. So as a result, there's an inventory of existing. There's a lack of inventory, there's a lack of movement, which should bode well for folks that are building single-family rentals, for folks that have multifamily rentals, because people are they don't have a lot of options, frankly, right? So they're not going to be a lot of movement around. So that's one of the reasons why we think residential as a sector, plus it has agency. You do have agency debt that's available in the residential sector, which unlike any other commercial sector that exists. So when we look at particular property sectors, and I do think investors are making those selective decisions. They're looking at what sectors are better positioned right now in this environment that we can still put some money to work.
Yeah, I mean, not much to add in that, but I wanted to go back to what Don said, which gets back to what we see in the market. When we were talking to institutional investors prior to 2022, it didn't matter what credit you bought, because you basically had a Fed put in place. So you bought the worst credit, and the drawdown, everything drew down, Fed came in, bailed it out, and everything rallied right back in. And now we're entering an environment where there is a true cost of credit, there's a true cost of a credit cycle that's developing across the board. And even in the resi space, there will be some sort of credit cycle. It'll be more tame just because it came out in a better place. So the conversations that we have with the LPs in terms of how to invest is also, are there ancillary strategies to the housing that we can get involved in? And I think that's a big shift that's happening, whether it's on the development side, whether it's builder financing, whether it's direct to homeowners. And for our European investors, there's an ESG element to it that gets them excited too, along with returns.
ESG seems to be in the United States a double-edged knife, right? Because you can be really ESG friendly, you get a Dutch pension plan and lose a southern state. So I'm not going to go down that path any more than I just did. What I will instead say is that the shortage of housing in the United States is creating a fascinating phenomenon, that home builders are operating as fast as they can, and they're scared to death while they're doing it. Because every time interest rates go up 50 basis points and mortgages go up over 7, nobody shows up for the sales. And then they go, oh crap, I got too many of these things. So we get every month I get a list of houses for sale from home builders, and it usually is between 10 and 20,000 houses that they want us to look at and decide whether or not we'll buy. So we actually can run a fairly fascinating, opportunistic program of buying houses from home builders at 20% discounts to list price. They still have some margin left in it because they're at record margins, and they're usually on lots they've owned for a long period of time. And so it's a terrific time to be buying houses, not from owner occupants, because there's none of those for sale. It's by home builders who, when they get down to the last 100 houses in the 400 house community, they just clear it out. So it's a little bit like buying sweaters in summer, right? And we've been really loving that opportunity. So I said I had an opportunity to do a commercial, so I did that. And I just think right now having that strategic partnership with big home builders, that way lending debt to the small home builders and working with them on getting assets, we've been able to exceed 6 on some cap rates, which is very attractive right now in our opinion.
Yeah.
Well, great. I have a couple of extra questions I could ask, but I figured at this point we could turn it over to you all in the audience for questions that you all might have. We will have some mics circulating around. Hopefully they work and work better than mine at least. So if you have a question, just feel free to raise your hand.
Or yell.
I can just be loud. What do you guys see as a potential catalyst that would cause more transactions in the market? More price discovery?
In my view, it's what we talked about earlier, which is that there's a settling down on where rates are. Okay, and we actually have we've had a number of our commercial brokers come in terms of the residential side and talk about the transactions that are now really starting to happen in the market. And these are what I would consider institutional quality transactions. They're not off the run. I mean, initially, some of the transactions you were having last 2 quarters where people were selling property with favorable in-place financing that could be assumed by the buyer. So those are really some of the ones that were going. Now we're seeing real, what I would call real transactions. So that gives me at least some hope that people are thinking that things are going to start to settle down a little bit, that you're getting close to the end. And when the market feels like it's going to, I keep using the word unstick, I think you will find a lot more transactions that will come in. Both buyers and sellers will feel better about doing business. And if the values are still in the wiggle room of 3 to 5%, people feel okay with that if it's the right asset and right location that they want. But if you think that the market's going to go down by another 10 to 15%, you're going to sit. You're just not going to do anything.
Yeah, I would also say rates just need to stabilize, and cap rates need to adjust a bit. But I was, when I started in the business, cap rates were 9. They weren't 4. Cap rates were 9, and maybe debt rates were 8, and people could make sense out of it, and you could still do transactions. But when the spread's too wide, or when you don't know what the debt's going to be next, then you kind of sit back and wait to see.
Yeah, listen, rate volatility. If it continues, as these 2 gentlemen said, you're likely to end up with a process that ends with a bang rather than a whimper. Cycles always end one of 2 ways. We touch down something that looks like a soft landing. It's never a soft landing, but we don't set the plane on fire, right? Or we just hit the ground really hard, right? And so right now it looks like we're only going to lose the wheel. Ship will win, right? But 1990 and 2000, there was nobody left alive on the plane, right? So it's usually the forcing function. Who has to sell? If nobody has to sell, the whole planet does extend and pretend, which is what we're doing right now. Right? It's cool. But if something creates a forcing function, which we all thought was going to happen in the first quarter, right? When the banks started getting rolled up, we were like, here we go, the forcing functions begin. Right? And everybody panicked, and everybody, kind of put their blindfold on and prayed. Right? And now we're in a position that's not happening. So I always look for a forcing function. Right now we don't have one. So rate stabilization is the likeliest scenario, but we have a bad history of trying to land the plane that way.
Great commentary, thank you. You touched on office, multi, resi. I would appreciate a little more in-depth feedback on on industrial, and has the new way to consume been fully baked into that food group?
I think one thing I can talk about industrial is what makes it really interesting as a property type is when I look at residential and I look at where in-place rents are versus what market rents, you're talking about generally in Sun Belt markets a delta of 4 to 5%, right? Industrial, the rents have moved up so much that in many of the logistics markets, you're talking 20 to 40% difference between in-place and market. And because the leases take a while to actually, residential again, 1-year leases, you're getting at that pretty quickly. The logistics properties, these leases are going to take a while to actually get at market rent. So even if we go into a mini recession, not saying that we are, but even if you get some pullback, there's so much cushion that's built into a lot of these leases right now that you can actually haircut them and still have a tremendous amount. So cap rates in a way are really hard to look at industrial product unless you have a view of what a market cap. If you marked the lease to market and you have a view of what that market is, that's truly what the cap rate is. You just have to know how long you're going to get there. How long is it going to take you to get there? And that's why we see money still flowing into logistics, even though there's price adjustment going on, is they're buying embedded potential cash flow that's there in those properties.
We still like the sector very much in Asia, in Europe, and in the US. And no, we don't believe trees will grow to the sky, but even at much more moderate rent growth levels, I mean, we're still seeing some rent growth. We're still seeing demand. Occupancies are still quite good. And even supply dynamics are a little bit different than they were when I started 25 years ago. You can't just build industrial anywhere. I mean, the last cycle, residential took a lot of industrial land out of play. So the supply-demand characteristics are a little bit better. There's still good demand, and we're still converting to the e-commerce kind of society. So we think it's an attractive sector still.
Go there and then later.
So what about office to alternative use conversions? Are your funds starting to look at those sorts of strategies?
We have not done any yet, and they're certainly possible in some areas, but obviously you've got to start with the right physical box, and that's not always available. You've got to have, not big floor plates. All the office buildings are not big floor plates. All those kind of issues. So it's a great idea on a spot basis, but it's not going to solve the problem, or at least I don't think.
Best way to answer that question is to actually tell a story. So about 4 months ago, we actually had an architect come in from Gensler, and they are part of the team at Gensler that studies office to residential conversions. And obviously, it's a silver bullet for a lot of municipalities that are looking at a tremendous amount of office stock that's not going to be occupied, particularly Class B and Class C. And it's interesting, they've put together, they had to do this for, Calgary was actually one of the markets that actually had a real problem when the oil pricing changed in Canada. So they first did it there, and then they started doing it in New York City. And when you look at it, they listed all these buildings that were mostly vacant, and they scored which ones were most easily convertible. It was like 5 to 10%, depending on the market. Okay, because of what I just described, right? Many buildings, very deep bays, you had very large floor plates, you'd have to cut internal areas of them. Unless it's an L or has some angles to it, it's actually very hard. But municipalities are going to be easy to say, look, we'll just convert these things, and it's easy. But when I think about how much stock in New York City that fits the Class B and C where I work, it's a tremendous amount, and that's going to be a lot to work through. The cities are going to have to give tax incentives. There's going to have to be some economic benefit to equalize that out, and I don't think it will be a silver bullet just to be able to do it. I think it's going to be a lot harder than people think it is.
So now we're just talking price, right?
You got to make it. You have to make it economically worthwhile for someone to go in and do all that work. And they were like, well, I don't know that I want to do. I want to go through all that brain damage because it even takes a long time to do that, right?
You have regulatory issues too. I mean, you've got to have zoning changed and all that kind of stuff. So there's a lot of work to do to make a big dent in the office supply.
All right, time for one more.
We touched on low resale inventory helping the multifamily market, but there's also concern in the market around overbuild or surplus of multifamily units in 2023. How are you thinking about multifamily starts as we go into 24 and 25?
If you don't mind me starting out, I would say to you that there's no question that there's elevated supply that's in a number of the Sunbelt markets. Atlanta, Austin, Dallas, Houston. It depends. There's really every single market that I can think of, there is elevated supply, and that really is an overhang from all the starts that came in 2021 and 2022. So when we look at the amount of supply that's going to be delivering in 23 and 24, it is a tremendous amount. It is a lot, and a lot of it is actually spread into the suburban markets. A lot of the supply pre-pandemic was in more infill locations, and now it is spread out in the suburban markets as well. And that excess supply is creating a moderation in rents across the board. We're seeing it. But what's happening now also is people are looking almost a little bit past it, right? Because when you think about it, who is starting new developments right now, right? There's not a tremendous amount. So the question is, what's going to happen in 2025 and 2026, right? So if you're actually not putting any shovel in the ground today, and if we can get past 24 into 25, we're actually potentially setting ourselves up for a significant drop in deliveries that will happen in 25 and 26. Now, am I deluding myself into that? No, but we're looking at it, and there isn't a lot of people that are starting new projects today. So I think the view is if we can get through the next 12 plus months of deliveries, which will naturally moderate rents, which should happen after a period of rents going up 20 to 30% since pre-pandemic, that we get into an environment where there would be much better supply-demand balance, and potentially even an opportunity for investors to capture an upcycle. And it's when you capture an upcycle is when you have the strongest rents, when you're coming out of a downturn or you're coming out of an excess supply period.
I would agree with that. I don't think we need to go any deeper.
Might be a good time to buy some.
Well, that concludes today's panel. Thank you to CFA Society of Atlanta for putting it together. Thank you all in the audience for attending, and a special thank you to our panel. Seriously, it was a fantastic panel with lots of insights and laughs as well. How about one more round of applause for our panel?